Nigeria's central bank held its benchmark interest rate at a record high as the threat of overspending in a pre-election year in 2014 overshadows a slowdown in inflation in Africa's biggest oil producer. Joining me down the line to discuss Africa as the new frontier is Samir Gadio. Annual inflation has remained in firm single-digit territory in 2013. Samir, I understand you believe a more sustainable single-digit inflation path in the long run will be conditional on the rehabilitation of the power sector and meaningful infrastructure development. Could you tell us a little bit more about this?
On the first point, the central bank has actually maintained the policy rate at a record high of 12% since October 2011. So in a sense, the last MPC confirmed this monetary stance. It's true that inflation has been in single digits recently, primarily actually on high base effects in Q1 and very benign month-on-month inflation volatility recently. But having said that, I think the key factor for the central bank is that there is a risk of fiscal expansion in 2014 as we head to the 2015 elections. And so in this kind of environment, there was really no incentive to reduce the policy rate. On top of that, the exchange rate has been broadly stable in recent weeks after the weakness that we saw in August, September. So actually, if you look at the effective monetary stance, the CBN has actually allowed an accumulation of liquidity in the system by reducing the amount of open market operations. So as a result, even though the policy rate has remained unchanged, actually you have more liquidity in the system and effective monetary policy is somewhat more expansionary in reality.
One negative came from President Goodluck Jonathan, who postponed his budget speech for a second time in a week after lawmakers failed to agree on the oil benchmark price in the 2014 spending plan. Now, this situation may not surprise market participants, but how will the added dimension of the looming election impact sentiment, do you think?
I mean, to be fair, I think the impact will be quite marginal because it's the same issue every year. So typically, the government will introduce a relatively tight fiscal framework for the following fiscal year, and then the National Assembly will try to push up the oil price benchmark, the overall amount of spending, and you're going to have months and months of negotiations, and eventually the budget will be passed probably somewhere in March or April. So it's not really a new scenario. Perhaps the concern this time is that we have an election coming in about 15 months or so. So the risk is that the National Assembly is actually going to try to push the oil price benchmark even higher, although until now, what we've seen in the media is that they will probably try to have an oil price benchmark of $76.5 to $79 per barrel versus 74 as proposed by the government. I must nuance that a little bit because in reality, the fiscal break-even point in Nigeria is much, much higher. The fact that the excess crude account, so the oil reserve fund, has declined to $3.6 billion in November, despite the very high oil price, suggests that the magnitude of fiscal expansion is quite significant, and that the effective fiscal break-even point is almost equal to the oil price itself.
The Nigerian market has experienced positive momentum in recent weeks, as illustrated by the resilience of the NGN and a rally in fixed income instruments. Even a new bout of EMFX weakness in early November had little impact against the dollar. Given this, coupled with the central bank governor's reiteration that the currency would not be devalued as long as he remains in charge, what do you make of the suggestion that this is a risk-free carry trade?
I think to some extent it is, because at the short end of the Nigerian curve, let's say if you take the 1-year tenor, you get paid 12.7% in the secondary market, and even higher if you can get the bills in the auctions. And the exchange rate is unlikely to come under significant pressure as long as Governor Sanusi remains in charge, because that's his legacy trade in a sense. If the Fed doesn't start tapering QE aggressively by let's say Q1 or Q2 2014, then actually the risks to the exchange rate are quite minimal. So you get a good carry. stable FX, why not at the end of the day?
Samir, if we lastly take a look at Ghana, the 2014 budget statement and economic policy of the government has drawn mixed feelings from parliamentarians. The plan to transform Ghana into a fully fledged middle-income economy through changes in revenue, mobilisation and expenditure has been described by a minority as unrealistic. Can Ghana really obtain EM status in the foreseeable future?
I mean, obviously, every government is going to try to make the case for an emerging market status within 5 to 10 years. And to be fair, if you look at the Ghanaian economy, it has transformed drastically over the last 15, 20 years. You can see that tangibly on the ground, new roads, new buildings, etc. But there is a big problem in Ghana, which is that the country is running large twin deficits of around 10% of GDP or so. And so the key issue in this budget was the pace of fiscal consolidation that the government was likely to pursue. We had a fiscal deficit of 10.2% of GDP in 2013, what is expected. The government wants to reduce it to 8.5% in 2014, which is a good step, but probably still not enough. And I think the concern also is that even though some of the measures on the revenue side are positive, there is an increase in oil revenue, an increase in VAT, the introduction of a windfall tax in the mining sector, the problem might be that on the expenditure side, it will be difficult to actually cap the wage bill, especially, maybe not necessarily next year, but especially from 2015 as the country moves closer to the 2016 elections. So it's still a mixed outlook, I would say. And the large fiscal deficit is driving also the current account shortfall and the continued pressure on the Ghanaian cedi.
Samir, thank you so much for your time and perspectives today. Well, viewers, that's all from me for the moment, but for a closer look at all things commodities, click back tomorrow when I'll be bringing you our second Commodities Corner of the week. Goodbye for now.